Well, welcome back to the second to last time. I think it's Pentaline, I think is the right term, second to last time to managerial accounting. And the purpose of this little mini lecture is to review the multiple choice part of the take-home exam of the exam number 3. I'll do a separate one on the take-home part of the exam. So we'll discuss the answer to each question, and we'll provide an explanation. So which of the following represents a favorable cost variance? A favorable cost variance would be any time that the actual cost is less than the standard cost. So you're looking for a case there where the actual cost is less than the standard cost. So your two choices there are B and C, and the correct answer is B. Favorable cost variance would be when the standard cost at actual volumes is greater than the actual cost. Standard cost at normal capacity is not something that we generally compute. So C is not the correct answer. The correct answer there is B. You get a favorable cost variance when the actual cost is less than the standard cost at actual volumes. Number 2, which of the following is a reason standard costs are separated into two components? Well, all of those are good reasons for separated into two components, because you want to take a look at the price and you want to take a look at quantity. You want to be able to segment what's causing the variance. So all of those are good choices. A, B, and C are all correct. Number 3, if the price paid per unit differs from the standard price per unit for direct materials, then what you're going to have is a C, a price variance. So the correct answer there is C. Number 4, Morocco Desk purchases 6,000 feet of lumber at $6 a foot. So that's what they actually paid, 6,000 times $6 a foot. So they have a $36,000 credit to accounts payable. But the standard price for the materials is supposed to be $5. So under a standard cost system, the debit to direct materials would be 6,000 feet, not what they actually paid, but the standard price, which would be $30,000. And the $6,000 would be accounted for as a direct materials price variance. So it's a debit to direct materials price variance, and a credit to accounts payable. So the correct answer there is A. Number 5, the following relates to direct labor for the current period, and they want to know the time variance. So the time variance is the difference between the standard hours and the actual hours. So standard hours were 7,500. Actual hours were 6,000, so they worked 1,500 hours less than they were supposed to. And you multiply that 1,500 hours times the standard cost, which is $11.70. So the direct labor time variance there is 17,750. So the answer is D. Number 6, favorable variances may be favorable volume variances. So a volume variance is when you actually produce more units than the assumption that we made in terms of what full capacity is. So this could be negative. Favorable cost variances may be harmful when the production in excess of normal capacity cannot be sold. So it's great that you produced more than was full capacity, but if you can't sell them, that's a real problem. So the answer there is C. Number 7. Unfavorable factory overhead controllable variance. So these are the variable overhead, may be due to which of the following factors. So if you have an unexpected increase in the cost of utilities, that would be a variable cost. So what could cause that? The answer there would be C. An unfavorable controllable variance may result from an unexpected increase in the cost of utilities. Number 8, the standard cost and actual cost for direct labor in manufacture of 2,500 units of the product are as follows. So standard costs are 7,500 hours. Actual direct labor is $7,400. Okay, and they want to know what the direct labor time variance is. So the time variance would be the fact that you worked 100 hours less than you were supposed to, multiplied by the standard labor rate, which is $11.80. So it's 1,180, and that is a favorable variance. Why is it favorable? because standard cost was 7,500 hours and you only worked 74. So you worked 100 hours less than you were supposed to. You multiply that by the standard labor rate of 1180 and you get 1,180, which is A. Number 9, the ratio of operating income to sales. Another word for that would be the profit margin. Operating income divided by sales, that is called the profit margin. It was in one of the take-home questions, so the answer there is A. 10, a franchisor may provide support to the franchisee in which of the following ways? Well, all the ways: advertising, management, development, supplier relationships. So the answer there is D. 11, Nelson Radio currently is purchasing transistors from Charlotte Company for $3.50. The variable cost of making those units ourselves is $3.25. So the range of possible transfer prices, you'd never charge more than you're paying the outsider to the outsider for $3.50, and you would never charge more than your variable cost of making them yourself. So it's got to be somewhere between $3.25 and $3.50. So the answer there is D. Number 12, which of the following is a measure of the manager's performance in a profit center? So a profit center, the manager who's managing that center would be responsible for generating a profit. So you would look at the divisional income statement. So the answer there would be D. Remember, you have cost centers, you have profit centers, and you have investment centers. So this one has to do with a profit center. So the profit center, you're going to look at the relationship between revenues, expenses, and profits. So the divisional income statement would give you that report. So the answer there is D. 13. In an investment center, the manager has responsibility for the authority to make decisions that affect cost, revenues, and the amount invested. So that's an investment center. Investment center, not only are you responsible for generating a profit, but you want to be able to compare that profit to the amount that's invested. So the answer there is D. 14. Division A of Katcha Company has sales of 140, cost of goods sold of 83, operating expenses of 43, and investment of assets 150. Investment turnover would be the sales divided by the amount of the investment. So 140 divided by 150 gives you 0.93. So the answer there is A. 15. Some organizations use internal support departments to provide services to divisions or departments within the organization, which defined would be considered a support department. Human resources, payroll, information systems, those are all support departments. So the answer there is D. 16. Most manufacturing plants are considered cost centers because they have control over costs only. So remember, you have cost centers, you have profit centers, you have investment centers. If you only have responsibility over costs, like in a manufacturing plant, that would be considered a cost center. The answer there is C. 17. Stryker Industries received an offer from an exporter for 15,000 units at $17.50 per unit. The acceptance of this offer will not affect the normal production of domestic prices. Following data are available. So you normally charge 20 to manufacture. The manufacturing variable cost is 11. The fixed cost is 1. The differential revenue. It didn't ask for the total difference of profit or loss here of taking the settle order. They want to know the differential revenue. So it'd be 15,000 times 1750 or 262,500. So the answer there is B. So there's the differential revenues. 18. Got a special order here for making 25,000 units of $16 per unit. The acceptance of the offer will not affect the normal production. Following data are available. The differential cost from accepting the offer, the only cost the fixed cost is going to remain the same. The only cost that would change as a result of the order would be the variable cost. So it's a special order of 25,000 and the variable cost is 11. So 25,000 times 11 gives me 275. So the answer there is, I didn't put it there, it's B. I'll put it there now. So the correct answer is B. 19. Carman Company can further produce product J to produce product D. Product J is currently selling for $20 per pound and costs $15.75 per pound. Product D would sell for $38 a pound, will require an additional cost of $8.55 a pound to produce. So the differential cost of producing product D, it's going to cost us $8.55 more. So I told us that, so the answer is B. 20, which of the following should be ignored in a make or buy decision? You should consider cost savings. You should consider quality issues. You should consider future growth of the plant and other production opportunities. The one that you can ignore is whether the supplier would make a profit that would no longer belong to the business. So you've got to select the best answer. The best answer there, what to ignore, would be D. 21, which of the following costs, what are you using the product cost of applying the cost plus approach to product pricing? Which of the following is included in the markup? So it would be this is your numerator, would be your total selling and administrative expenses plus the desired profit would all be considered when you use the cost plus approach to pricing. So the answer there is D. 22, the revenue that is foregone from an alternative use of an asset, that's called an opportunity cost. That's the revenue you give up. Anytime you make an investment, rather than making an investment, you could have just put that money in the bank and you could have multiplied the amount that you're investing times whatever interest rate you could have gotten on it. That would be the opportunity cost, which is the income, the revenue you forego for tying up an asset. It's called the opportunity cost. The answer there is D. 23. This has to do with break-even analysis. So to get the break-even analysis, you take the fixed cost, which is $12,000, and you divide that by the contribution margin, which is the seats are sold for $200. The variable ticket price is regular ticket price is $200, and you're going to attract customers by discounting the price by 50%. Break even regular price for the tickets would be the $200, the sales price, and it cost us the break even there, variable cost. Yeah, variable cost per unit is $50. So 200 is the regular sales price. Variable cost per flight is per passenger is $50. So 12,000 divided by 150 gives you $80. Okay, so the break even on regular price based on the regular price would be 80. So the answer there is B. 24. Sterling Company is considering disposing of a machine with a book value of $12,500. Well, that's irrelevant. We don't concern ourselves about book value. That's considered a sunk cost. Estimated remaining life of 5 years. The old machine can be sold for $1,500. A new high-speed machine can be purchased for $25,000. It will have a useful life of 5 years and no residual value. It's estimated that the annual variable manufacturing cost will be reduced from $26,000 to $23,500. That sounds like a reduction of $2,500 a year. The 5-year differential effect on profit or for replacing the machine is, so you got a $1,500 cost of the machine. Here's your savings. You're going to save $500, you're going to save $2,500 for 5 years, but you're going to have to pay $25,000 for the new machine. So what you have here, the incremental effect on profits, is $1,500 plus 2,500 times 5, which would be the savings there, minus the cost of the machine. The cost of the machine is $25,000. So you're actually going to decrease profits by investing in a new machine by $11,000. So the answer there is A. 25. The management of California Corporation is considering the purchase of a new machine with a cost of $400,000. Company has a desired rate of return at 10%. Present value of $1 computed at 10% of years 1 through 5 is below. In addition, use the following data in determining the acceptability of this investment. Okay, and they want to know the present value index. So to get the present value index, you got to come up with the present value of all these future cash flows. So the net cash flows, you got to take 1,800 and multiply by 0.909. You got to take 120 and multiply by 0.826 and so forth using these factors. And when you multiply out all these present values here, You get present value of 455,200. The amount of the investment is 400, so you get a present value index there of 1.14. So the answer is C. 26. The production department is proposing the purchase of an automatic insertion machine. It has identified 3 machines and has asked the accountant to analyze them to determine which one has the best cash payback. Round the cash payback to the 1 decimal place here. So when you figure these out, the one that has the shortest payback would be B. So this has a payback of 5 years. So the answer there is B. 27. Which of the following capital investment analysis method is used? Which of the ones ignore present value or the time value of money? The 2 that ignore the time value of money or the present value, or the average rate of return and cash payback. So the answer there is A. 28. Which of the following recognize that the dollar today is worth more than $1 tomorrow? Well, that's the time value of money. So the answer there is C. The average rate of earnings is 12%, and the cash to be received in 2 years is 10,000. Determine the present value of the amount. So you take 2 years at 10%, you get 0.797. Multiply that by 10,000, you get $7,970. So the answer there is C. 30. The 2 managerial accounting tools useful in considering the uncertainty of the estimates are sensitivity analysis and expected analysis. And those were the 2 methods considering uncertainty of estimates. So the answer there is A. 31. Which of the following is a qualitative consideration that may influence the capital investment decision? Well, all of those have to be considered. So these are qualitative, not quantitative. So after you get done with the quantitative assessments, whether you would go ahead and make the investment or not depends upon the investment's proposal's impact on productivity, impact on strategic opportunities, the impact on product quality. All those would be considered. So the correct answer is D. And 32, in capital rationing, the alternative proposals are initially screened for a minimum using which of the following 2 evaluation methods. So for initial screening, remember the last thing we talked about in chapter 12, you had to come up with a kind of a decision tree of whether you'd make the investment. So what would happen is you would screen the proposals on the basis of payback and average rate of return, and only those ones that met that threshold would be considered further with the more complex methods, which consider present value. So the initial screening would be done on cash payback and average rate of return. So the answer there is A. Okay. Hope you found that little review useful, and I'll do a separate one on the take-home part of the exam. Be well, everybody. Hasta luego. Auf Wiedersehen. See you all shortly.